Welcome to Dallas Stock Talk, where I talk about topics relating to investing and finance, but more specifically, the stock market. Now, in this video, I'll be going over 7 common mistakes that new investors make when investing. One of the major things that I've seen that new investors normally go wrong is they don't really know the difference between speculating and investing. Speculating is more off opinion based, or maybe what other people think, or, oh, because they make nice products, I want to invest. That's more the speculating side. With more the investment side, you're making decisions off of evidence that you've researched, that you've looked at. You're looking at financial statements. You're making sure you understand how the company generates money. You're making sure you understand the company's financial situation, understanding how management works. You're familiar with the company's outlook for 5 or 10 years. You're looking at the company's ability, if they pay dividend, to pay. You're looking at so many different things outside of the company making good products or the favorite company that's trending right now. So I'm not saying that nothing's wrong with speculating, but I definitely think it is important for you to know the difference between speculating and investing. Small interruption. Make sure you hit the like button because it definitely helps the YouTube algorithm. It lets YouTube know that it's quality content and it helps my videos reach a broader audience. Another thing that I think is a common mistake is trading off of emotion. Underestimate this because they know, okay, don't act off of emotion, but from personal experience, even veteran investors make a lot of times when situations happen and in the real time, you think you're not going to act that way, but when your money is on the line, you tend to act off of your emotion. A lot of times this happens, like I said, with everyone. You're in a situation, you really don't exactly know what's going to happen. You're hearing bad news here, bad news there. So you're thinking, hey, this time is different. Let me just cut my losses early. Or it may be the other way around. Like all you're hearing is good news, good news. You're seeing the stock market rise and you don't want to miss out the FOMO. By the way, FOMO, the fear of missing out, is real. So, and I think that's a lot of times when people end up making bad decisions, it's based off because their emotions. So if they have high hopes, they get excited. Okay, I'm invest. And then as soon as they hear something bad, oh, I'm gonna sell. So those are things that I think get a lot of investors in general in trouble. This is my personal opinion. When you end up investing, I really think that it's important for you just not to just make a quick trade, just kind of really think about it, compare the pros, compare the cons. And I also think it's very important to look at your investor. So make sure you look not just in the now, but on a longer time span. So before you just be quick to sell, looking at my pen, sell a pen. But before you're just so quick to sell, make sure you look at it. Is this problem going to be temporary? What's the likelihood of this situation end up going well? So I think you definitely want to pose questions and really challenge why or you're buying or selling. Make sure you have evidence of not just based off of opinion of why you decide to buy and sell. So that is, I think, another common mistake. Okay, the next thing I noticed, a lot of times when you're a beginner, a lot of people become overwhelmed and they wait too late. They try to wait for the perfect moment. Oh, if I can just do this, or if I can just gather this, I want to get that. And then 1 year goes by, 2 years go by, 4 years, and then you haven't even started. So I definitely think it's important, even if you might not be in the best financial situation, was at least to start. Nowadays, the entry level to start is pretty much maybe $1, $5, and $10. So maybe if you can just do $5 a week, $10 a week, even $20 a month, I do think it is very important that you end up starting, because once you end up starting, you have more questions, you're curious, you learn things, and then you kind of definitely see how you react due to certain situations and how much you're influenced and how much you're really willing to dedicate investing. So I think that is very important. I've definitely seen a lot of people, they're interested, but they think it might be too much to learn, or they might not think they're in the best situation to do it. But I do think it is very important to get your feet wet, to get some exposure, And then that's how you become a better investor. So when you do accumulate a lot of money, you already have knowledge, experience, and then you'll feel a lot more comfortable. So I definitely think that is one. Another common mistake that I see new investors make is trying to time the market, trying to get in and leave at the right time. I know you're familiar with the buy low, sell high. It sounds real simple on paper, but let me explain to you why it's so difficult, and a lot of times it's very problematic. Because a lot of these, the stock market is based off of future events that no one actually knows. So a lot of times, by the time you realize that it's safe, maybe you had already lost major gains. And the other way it could work in reverse. Try to sell, and then right when you're about to sell, you missed the stock going up substantial. And each time you keep doing it, the more difficult you're going to make it on yourself, because the more times you have to be right. And statistically speaking, trying to guess events that you don't know and trying to make decisions off of that, most of the time it's not going to be in your favor. And I'll give you an example. There have been, especially on the times that the market best days, 5 or 10 best days, you could have missed major returns. We're talking about double digits. So that's why it's important to try to make sure you don't try to time the market, because most times it does not turn out well. Not unless you have a crystal ball. Another common mistake is following the crowd, or always trying to invest off of what other people think. Now, this is very common that I've basically seen. A lot of times people cut on the news. The news says this. Oh, they say this. Oh, this person say this. I should invest in this. But I definitely think it's very important for you. It's okay to like follow some trends, but I really think it's important for you to make sure you understand your personal reasons for why you want to invest, and not just kind of investing because other people say, or this expert on this TV said, oh, get this stock, oh, get this stock, or this stock is going to crash. That's why I think it's very important for you to do your own independent research, even if you're not that much familiar. But I definitely think it's you to at least be familiar with the financial statement, be familiar about how the company, what type of business they're getting into, so that you can have your own personal reasons and not just because other people on TV or other experts say it. So I think that is a common mistake that investors make. And then I think another common mistake is investing money that you don't have. I see a lot of people, they want to make money quick. They invest money that they're probably going to need in the near term, maybe 1 month, 2 months, or 3 months. And then what ends up happening, things don't go the way they expect, and they're in a really bad situation because the regular practice, they can't like hold or wait it out because they actually need the money. So I think it's absolutely important for you to know, like, if you need the money, don't invest. Trust me. And I also think, especially if you're a beginner, to don't invest off of borrowed money, because that's how you really put yourself in a bind. Because not only do you not have the money, you're borrowing money. Investing money you borrow, things can go really bad. So I definitely think that you should only invest money that you can lose. I think that is very important. I see a lot of people, they're like, okay, I'm just going to invest money here. I'm going to invest money here. It don't turn out in their favor, and they end up screwing themselves over. And my last and final thing, I think it's very important for people to be honest about their expectations, their amount of risk, and how much time they're willing to put into it, especially if you're trying to better returns than the general market, which is, it's very difficult. It's not impossible, but it's very difficult because most professionals over a longer period of time, 5, 10, 15, 20, they fail to outperform the market. So especially if that's something that you were interested into, of getting great return, I really think it's important for you to be honest with yourself and asking, how much time am I willing to invest to get great returns? If you're not going to be willing to, do the research, or you kind of know, like, I like to spend my time otherwise, I think it's important for you to kind of know, like, okay, if I'm really going to try to get huge returns, that I'm going to have to put in a lot of the time in research. So if you're not willing to do that, it may just be better just to take the average returns from the S&P 500, which is 7 to 10%, and you pretty much don't have to do anything. You just have to consistently invest and get that 7 or 10% return historically. And that's the end of this video. Just in case you haven't already, make sure you hit the like button. And if you're new to the channel, make sure you subscribe and you hit that notification button so that it'll let you know when I make new content.